Welcome back. Well, we just talked about markets being at or very close to record highs. Our next guest says that when markets are hitting highs, it's time to be cautious. Joining me from London, England, is Bill Blain. He's author of the Morning Porridge newsletter, founder of Windshift Capital, and a partner at Shard Capital. He joins us again from London, UK. Bill, thanks a lot for joining us. What do you make of these North American markets, which, as we have noted, have surged higher since early April and are now solidly in record high territory?
Yeah, well, you've not just got record highs in the stock market, but also record tight spreads in the bond market, as well as the record high in stocks, of course. And it's when you get into that situation where markets look to be priced for some kind of perfection, and clearly the world is a very imperfect place, that's when you got to say, whoa, what's going on here?
And so what does that lead you, what does that posture lead you to do? Do you recommend, for instance, that investors trim back some of their equity exposure, trim back some winning positions and take some profit?
Okay, well, let's be philosophical just for a moment here. There's a great difference between trading a market, which is where you're following where the sentiment is going and what markets believe moment to moment and short term, and making long-term investment decisions. We're in very much a trading market just now. And the market's high because it's not seen all that negative news about the TACO tariffs and potential recession and potential new supply chains. It hasn't seen these things actually come to fruition. So the market's getting positive. The market's also positive because they're beginning to think that the Fed is going to ease US rates quite quickly and everything's going to be really positive for stocks. Whereas if you sit back and you watch and you listen to the data, what you actually hear is this stuff is all backloading. And it may not happen, but there's still a very high likelihood that we will see the impact on the US economy and thus the global economy come in the near future. So the market, I feel, is getting very complacent about the risks just now. But if you're a trader, go with the sentiment that we're seeing just now. The key thing is it's fine to miss the last 2% of a rally rather than catch 50% of the crash that inevitably will follow.
Okay, so I'm going to ask my question again because I think it's an important one for our viewers who, by and large, are long-term investors or traders. For a second time, is this the time to trim back equity exposure, to reduce equity exposure? Is this the time to sell some winning positions and lock in some gains?
I would certainly think about that. I mean, I'm not trying to avoid the question. I'm not a politician. But certainly there are times, I think, to look and say, what are the things that have the least likelihood of succeeding? Where should I be, for instance, in AI? Clearly, there's going to be winners in AI, but not all of them. So which are the names that are going to succeed long term? When it comes down to fundamental stocks, though, I think, yes, you've got to make a call and say these things are going to be supported, oil and gas in the States, utilities elsewhere, and pharmas. So yes, there are some things you want to hold because even if there is a correction, it will not be as devastating as people fear. We're not going to see a massive reset. All we're likely to see is the market think, okay, this is worse than we thought it was going to be. I'm not trying to dodge your question, but I don't want to give specific stocks to buy or sell on the result of this because I think they become fairly self-evident. I mean, if you wanted one definitely to sell, it would be something like Tesla because that is completely unsustainable. But there are good arguments for supporting some of the others.
You say you're concerned about corporate debt, and you note that corporate bond spreads are hitting record tight spreads. Talk to us about that.
Yeah, that is really interesting that corporate bonds are so tight, and there are some good reasons for that. The first is that in the US, the biggest corporate bond market in the world, President Trump has enacted policies that are positive for car makers and oil companies. That means these companies are going to do the only thing that bond market holders care about, which is the prompt repayment of principal and interest. So they're happy. There's also the fact that we do think the Fed now is going to be bounced into an early ease. Whether that's a result of Trump's pressure or not, it's another matter. And then there's a really interesting development going on in the private credit markets where we're seeing a massive regulatory arbitrage underway. And by that I mean, let's go to the story, which is Meta, Mark Zuckerberg's Facebook. They're going to borrow $29 billion to build all their data centers. But instead of doing that as a corporate bond, which would require them to do all the work that's associated with that in terms of meeting all the legal obligations and reporting, they're going and they're asking all the big private credit firms, that's the hedge funds like Carlyle and Apollo, who do private credit, to give them the money they're looking for. Now, that makes sense on a number of levels for Meta. It means they can be very closely aligned with the guys who are now providing money to the tech sector. It's also fascinating today that we've seen Peter Thiel, the tech lord in chief, the tech billionaire investor, announce that he's launching yet another Lord of the Rings themed vehicle, and this one's going to be called Erebor, and it's specifically there to replace Silicon Valley Bank as the major funder to the tech sector. So what this is an alignment of tech funding with the tech businesses. And as a result of that, it means that there is less supply coming to the public bond markets, which is one reason spreads might be slightly tighter, because people are looking to invest in corporate bonds ahead of the Fed easing. However, I do think it begs questions about the lack of transparency in the private credit markets, especially when you have tech billionaires so closely involved with tech investors. Interesting thing to think about for the future.